2 minutes until the closing bell, and taking us there are Andy Richman. He is Sterling Capital Management's Managing Director of Fixed Income Strategies, and Larry Adam, Raymond James CIO. We're going to check in with both of them in just a second, along with Shauna. But first, we're going to head over to Jared Blickery because we are headed towards some records.
Yes, we are. We're heading toward a record for the Dow and the S&P 500 and some of the industry groups as well, like the chip sector. You can see the Dow's holding over 1%, S&P 500 up a bit more, and the leader of the day, Nasdaq, up over 1.5%. And even the small caps are starting to make some gains here, up about 0.25%. And it's really been about the mega caps today, as we have been talking about. Alphabet up 4%, at a record high, along with Facebook and Microsoft. Tesla notably tacking on some nice gains there, up 4%, had been up about 5 or 6% before that. But we also want to check out some of the meme stocks because GameStop, guess what? Another $1 billion in shares doesn't seem to be hurting the price that much, only off about 3.5% today. Some of the other names in focus, BlackBerry, that's up 8%. And AMC, check that out, that's up about 12%. Also looking at the travel space. Adam, you're talking about records. Well, we got Southwest Airlines closing in on a record. Probably won't hit it today, but getting very close to those old highs from late 2018. And just got some news about the pilots that 209 are going to be called from extended leave. So good news in that sector. And also Norwegian Cruise Lines announcing that it may get back to the seas in the U.S., leaving from U.S. ports as soon as July. We'll have to see how the CDC decides to weigh on that. Other than that, just looking at the sector action, it's really been about discretionary today, along with communication services and tech. Those are the three FANG-lighted sectors that are up the most today. Here's that closing bell.
Another record day today on Wall Street, like Jared was just saying. We got that strong jobs report on Friday, raising the expectation for a quick economic recovery. We saw some buying here today on the heels of that report. S&P pushing further above 4,000, Dow closing up 372 points. The Nasdaq was a big outperformer today, although not by that wide of a margin. The Nasdaq closing up just over 1.5%. Leadership today, like Jared was just saying, coming from consumer discretionary, communication services, and technology. Those three sectors leading the way today. And of course, some of those big cap names, Amazon, Microsoft, Google, amongst the massive outperformers in today's action. But let's get back to our panel. We have Andy Richman, also joined by Larry Adam. Larry, let me just start with you. Another day of record highs, the S&P pushing further above that 4,000 mark. What do you think is behind today's rally? Is it all because of Friday's jobs report or something else going on as well?
Well, I think it's just a realization. There have been a lot of false narratives out there that interest rates were going to take the markets lower, that inflation was going to scare the markets, the Fed. And the realization is that the economy is doing very well. And what we're seeing is that not only is the economy doing better, but that's actually leading into earnings revisions going higher. And that's taking the market higher. And I don't think we're done yet. I think people are going to continue to see the strength of this economy during the summer. And you're going to see earnings continue to move up significantly throughout this year.
Andy, when we talk about earnings moving up, we're also watching the yield on the 10-year move up. It's at 1.72. Will we hit 2% within this quarter? And would that have the ability of stalling the growth that we're now witnessing?
Yeah, good question. We do think rates are headed higher here. Whether they go to 2%, we think that's certainly possible here. We saw obviously a really big move in the first quarter, and what we saw was basically a reset of Fed expectations by the bond market anyway, kind of pushing those up a little bit, reset for inflation trends, and a reset for growth trends as well. And then you have vaccines coming on. So those are all going to factor in, not even taking into consideration stimulus right now, that are going to send rates higher, we think. So while rates have moved significantly in the first quarter, we think there is room and could push against that 2% level. And what that does to growth, I think you can still grow at 2%. We've been above that since the great financial crisis. So I think we're going to see growth for our expectations really being ahead of what most estimates right now. So we're slightly above on growth for the year still.
Larry, how are you looking at this, the possibility that we could potentially see higher yield? Are you adjusting your strategy at all?
No, as I said, interest rates moving higher, they're going higher for the right reasons, right? And as long as they don't go significantly above that 2% level, I still think that this equity market can continue to move higher. As I mentioned earlier, if you look at the consensus, just keep in mind how powerful these revisions have been. We came into this year, the consensus was for 4% growth. We're approaching 6% growth. And that better growth is going to offset any upward movement in interest rates. So I'm comfortable with rates going up to that 2% level, but I don't think they go much above that.
Larry, I want to keep on what you just said and follow up with something. Yep. You've pointed out that you are cautious about the reopening with the hotels and the airlines and leisure facilities. We just saw Southwest bringing back 200 plus pilots. We've got TSA throughput at 1.5 million now. I checked out hotel prices. Really expensive in wine country in California, still cheap in DC. What do you make of this?
So I still think that some of those reopening trades are a little bit too expensive from my perspective. And one of the things we like to do is look a little bit further into the future. And we're looking at 2022 earnings. And the reason I do that is to get away from some of the noise of the big downward move and then this year, the big upward movement. And if you look at 2022, for example, you've seen tech earnings being revised up more than 12%. If you look at those reopening sectors and industries that you're talking about, they're still been revised down 40%. So I think there's an over-optimistic sentiment being priced into those areas right now. So I'd be cautious with a lot of those areas.
Andy, we certainly had a very, very strong start to the year, to say the least. And it's interesting because investors don't really seem to be spooked about much. Yes, I guess the prospect of higher rates, initially we saw a bit of a pullback there. But once again, today, we're at those record highs. Now there's talk of higher taxes. Why don't you think that's catching, or I guess making investors nervous at all?
Yeah, I think it's still all about the stimulus that's being added and the fact that we're coming off such tremendously low growth rates last year. And again, what we're seeing is all this hiring coming back on. We saw a tremendously strong jobs number, as you pointed out, in March, the average for the first quarter well above consensus. So with that and housing, and the market going up, it's certainly been good for the consumer here and a lot of consumer spending. I think you're right, though, in the second half, that could weigh on things. And certainly then with taxes going up, I think, again, with the prospect of corporate and individual taxes going up and stimulus, I think that could weigh in the market towards the second half. But I think that's more of a second half phenomenon. And the first half is really looking past this pandemic and looking for the recovery right now.
Andy, very quickly, we saw, though, in the last jobs report that the pressure on wages doesn't seem to be one of the things driving inflation. Is that going to change?
Yeah, good question. And certainly that's what the Fed's grappled with right since the financial crisis. There's been no wage inflation. And that's why they've been able to keep rates so low. And that's why we've seen things move here. We're seeing some pockets of wage inflation, but that's the big wild card. And the Fed is saying, not only are we going to wait for 2%, but we're waiting for really 2% to be sustained for a while here. So the Fed is extremely dovish. And they're saying, as in their words, any inflation will be transitory. Whether it's going to be transitory or permanent, yet to be determined. But I think what holds wages down, that's been doing that, continues. And that's the structural issues we've seen about technology coming on board and aging demographics. So those still really are going to weigh on keeping wages going too high. So do we see wages higher? The answer is yes. Do we see them materially higher? The answer is still no.
Andy Richman is Sterling Capital Management Managing Director of Fixed Income Strategies, and Larry Adam is Raymond James CIO. Gentlemen, thank you both for joining us.